Thanks everyone for your time. My name is Mark Freeman. I'm the Finance Director for Calima Energy. I've been working with the company since 2015 and the company has been transitioning into our current form, which is an oil and gas producer in Canada. We acquired the main Alberta assets just over a year ago. And since then, we've undertaken quite a significant growth pattern of the assets. So as you can see, the company is currently, we are currently producing around about 4,150 barrels of oil per day. Our Q2 production just came out today, and we put out our quarterly report with our gross revenues for the quarter of 37 million and our earnings before depreciation of 22.6 million Australian for the quarter. So that's been our best quarter to date, and it's been a phenomenal progression over the last two quarters. The company has around 612 million shares on the issue. We trade on the ASX under CE1, as well as on the OTC. We recently listed there with the code CLEMF. The market cap is around 100 million, and we have our first inaugural dividend going out to shareholders. It'll be going out this quarter of $2.5 million back through there. In addition to that, we're currently in a buyback phase, and we've been buying back shares since mid-June, with total shares bought back of around 4.5 million shares so far. The company has quite significant reserves. Our 1P reserves are sitting at 15.6 million barrels equivalent, and that's around about 65% oil, which is quite significant when you're comparing companies. In addition, we have 3P reserves of 24.4 million barrels, and outside of our Alberta assets is our Montney asset, which has a 2C resource of 160.5 million barrels of oil. And we'll run through all of those a bit later on. The company has a pretty de-risked production base. We have over 84 producing wells in our core areas, which are our Brooks and Thorsby region. In addition to that, we have a very low operating cost of around $16 per BOE. Sorry, just an interruption there. What I've brought up now is just a slide of where we're located. The Montney is up in the north east of British Columbia, and our production is down in Alberta in our Thorsby and our Brooks region. Importantly, our core operating group is based out of Calgary. I'll run you through the staff a bit later on, but that's the most critical part of the business is having people locally based, and we have a staff that is around about 30 people, with all our executive, our managing director sits in Calgary along with his core team, and they've got access to get through to Brooks and up to Thorsby, and Brooks is about a 2-hour drive, Thorsby's about a 3.5 hour drive away. We've been extremely active. The wells that we're drilling are relatively low risk. This is not a case where you drill a well and you end up with a dry well. We're drilling wells and we're ending up with either really good wells, type curve wells, or slightly below type curve wells. So since acquisition, we've drilled 7 wells last year, which were 4 Brooks wells and 3 Thorsby wells. And in the beginning of this year, we did 7 more wells, and we've just recently done another 5-well campaign, which was 4 wells down at Brooks and a frack of one of the wells that we drilled up in our Q1 quarter. So year to date, production of 705,000 barrels of oil, which is an equivalent of about 3,900 BOE per day and 70% oil. Our estimates for half 2 of 2022 is 776,000 BOE per day, barrels of oil, with 4,218 BOE per day at about 66% oil. I'll run you through our financials. As I said, we've just put our quarterly activities report out this morning. So pretty substantial results. We increased our revenue by about 7 million, and that was mostly thanks to the benefit of the oil price being very strong. Our royalties sit very much consistently at about 19% of gross revenue. So that came in at about 7 million this quarter. Operating costs came in a bit lower at 5.4 versus 6.3 our last quarter. G&A is quite consistent across the board. We've got a relatively low G&A and interest obligation, so as I mentioned before, our adjusted earnings for the quarter was 22.6 million versus 17.6 in the prior quarter. Most importantly, what's been hitting us the most has been our hedge losses. And that this quarter came in at 8.5 million. The company took out swap positions last year, mid to late last year, where it had an obligation to do so under its banking conditions. That obligation meant that the company had to put 50% of its hedges in place. As you can see, the projected hedge losses for H2 are 5.2 million. And all of our hedges expire 31 December, so we're completely naked at that stage. More importantly, we no longer have any obligations to undertake any swaps or hedges. Our banking facility it triggers an obligation to do hedges only when we're drawn down about 50% of the facility. We have a revolving credit facility with the Bank of Canada for 27 million Canadian, and at the end of 30 June, we had not drawn down on any of that facility. This leads us through into our Capex, and it's really important when you're looking at an oil and gas business to ensure you understand what capital expenditure is required. So year to date, we've incurred about $26.8 million worth of Capex, and we're anticipating a total of 44.9 million for the year. This includes some non-recurring factors, which is primarily associated with a pipeline that we built, which connects most of our production from north to south in our Brooks region, and some additional capital that we spent earlier this year, which enabled us to ramp production up quite substantially, as you could see from our previous production graph. So we have a total of 44.9 million anticipated Capex for this full year, which would leave us with cash flows of about 14.9 million. What we need to reflect on is the value of the business, excluding some of these non-recurring items. And our expectation is that sustaining capital will be around about 25 to 35 million. So when you reverse out the impact of the hedge losses, which were a total of 18.7 million estimated, and you reverse out additional Capex, which is not anticipated, the business should generate around about $50 million worth of free cash flow. So that's what we're anticipating next calendar year. As I mentioned, the board and management are based in Calgary. We do have 2 board members in Australia, which is myself and Glenn Whiddon. Glenn is a very experienced corporate entrepreneur. He has a substantial interest in the company and has been essentially working with Calima over the last 20 years. Jordan Keevil is our managing director. Jordan has worked with Black Spur for the last 10 years and knows the business inside and out, very well, very knowledgeable in the region, in particular within our Brooks and Thorsby region, which is quite critical to the development of the assets. In conjunction with Jordan is his right-hand man, Graham Veal. Graham is a phenomenal engineer. He's worked for a very long time, again, since the inception of Black Spur, and knows these assets inside and out. And in conjunction with Graham, we've got Kevin who is our operations manager, and Kevin's been working with the company for the last 5 years, but he's a very experienced E&P guy, and he has done a phenomenal job in managing the assets and ensuring that they, anytime there's an issue, he's right on it, and in conjunction with his operations team, and all the ops teams guys work pretty much at location. And that's the beauty of working in Canada. You've got access to a phenomenal amount of expertise on the ground. The guys that are operationally on the ground live close to Brooks and Thorsby. They've got permanent access to it. Brooks and Thorsby, both those regions have permanent year-round access. We can drill most of the year. We typically don't drill through April and May as a result of the weather and breakup, essentially when the ground's sort of frozen over winter and it's quite cold, and then the ice melts away and it makes things a bit sloppy. And we just recently employed Jerry Lamb as our CFO over in Canada. This is his first week. So this was his first quarterly, and it was very well done. Our other local directors are Cole DeMong, who's an engineer based in Calgary. He's had over 25 years experience, both international and domestically. And Lonnie Tetley is a non-exec director who's a lawyer who's also very well connected in the area. The takeaway points of the assets, and before I get to the detail, is that these are top tier assets. They're low production assets. They have a robust production profile, and they do provide sustainable free cash flow. When you, as I mentioned previously, when you reverse out the impact of the hedging and the additional capex that we spent this year, this company will be generating $50 million of free cash flow. When our market cap today is around about $80 million, it doesn't take much to see that there is a lot of upside in new shareholders coming on board. This slide is a comparative analysis. What we've attempted to do here is compare companies that are producing in Canada and how we rate in comparison from an EV over production basis and an EV over 2P basis. And as you can see, we're right down the bottom of the scale from that perspective. All of the references are as to where I got this detail from are in the back of the slides in the appendices. This is a picture of our current drill program. We have two wells, Gemini 8 and 9, that we drilled and completed in June. They're on production presently, and our Pisces 4 and 5 have now been drilled, and we're currently awaiting their fracking. And in addition to that, we have fracked our Leah number 4, which is a step out well in our Thorsby region, and we'll run you through that. And then we have our estimated wells that we anticipate drilling in the next in the second half of this calendar year. So all of our regions have multiple producing intervals, and the beauty of it is we have a very flat landscape that we can get onto. We have all of our core batteries on site. So we essentially have a pipeline connecting our batteries, our main north and south batteries at Brooks together. We can get in there, we can drill a well, and then we can tap straight into our existing pipeline, and that'll take all our fluid to primarily our 229 battery. We produce both from the Sunburst, which is this lowest interval down on the right side image, as well as from our glauconitic intervals. The Sunburst is a very straightforward, conventional type structure. We drill, complete, and put on production. Our best time to date has been 14 days. So it's a very easy well to drill. They clean up pretty quickly and they're on production pretty quickly. So our Gemini 8 and 9, which we drilled in June, they were on production early July and are currently doing around about 190 barrels of oil per day. The glauconitic wells do require stimulation. Sorry, just back to the Sunburst. These wells will pay back within 6 to 7 months at $85 oil price. The glauconitic wells are a little bit more complicated. They require some fracture stimulation. The AFE costs are around about 2.6 million, and their paybacks are 11 to 12 months at $85 WTI. There's a couple of images from our 229 battery. We have what's called an H2 sweet plant. We do have sour gas in Canada, and our obligation is to remove the H2S from the gas prior to sending it down the pipeline. Our facility enables us to do that both extremely economically, but in addition to that, the facility actually produces a very inert sulfur substance that can be placed into landfill or can be separately processed. We own the 50% of the IP of this particular plant. It enables us to process gas extremely cheaply at about 30 cents an MCF. And it's a phenomenal asset to have within the company. This is an image of our Brooks region. I was talking to you previously about 229, which is the plant up in the top north here. We've got our other oil battery to the south and a couple of oil batteries to the east, as you can see on the map. And the yellow pipeline is the pipeline that we built earlier this year, which was functional at the end of March. Total production coming out of Brooks was about 2,700 BOE per day. Our total reserves in the Brooks region are PDP 2.9 million barrels, 5 million barrels of proved undeveloped, 1P is 8, and 2P is 10. When you're looking at the type curves on the Sunburst and the Glaucs, as you can see, both of them have reasonably good internal rate of returns. The Sunburst sitting at around about 270% and 90% on the Glaucs. The Sunburst obviously have a pretty good payback. You're essentially coming out at 8 months at $85 WTI, and that's on your average well. These wells do vary, and we do have some wells that are quite phenomenal. We had a well drilled last July. The well cost us about $980,000, and to the end of June, it generated around about $4 million after costs. So some of these wells can be quite phenomenal. The Thorsby region is primarily a fracked structure. It is a fracked structure, I should say. We're drilling in what's called the Sparky. You can see it up on our 3D map on the top right. These wells they are a little bit more expensive than our Glauc wells, and I'll just quickly jump down to the economics. So typically we spend about $3.7 million Capex. Payout is in about 10 months. And the reason for that is the high production rates. So the IP90 is about 275 barrels of oil per day, and break-even costs are around about $39 WTI. The Thorsby region produces currently around about 1,500 barrels of oil per day. It's quite clustered within this area. You can see it on the map. The Leo 1, 2, and 3 are the wells that we drilled late last year. They're pretty significant contributors to our overall production. In addition to that, we had a step-out well, which is our Leo number 4, which is very exciting for us because it does provide us with a substantial amount of reserve upside up in the north region of the company's asset base. This particular well has been fracked and it's currently flowing back, and we're very much looking forward to the results of it over the next few weeks. Just running through the reserves up in North Thorsby, we're sitting with PDP reserves of 2.3 million barrels, 1P reserves of 7.6, 2P of 10.4 million barrels. Just moving on now to the Montney as I mentioned earlier at the beginning of the presentation, the Montney has a 2C resource of about 160 million barrels of oil. In addition to that, it has prospective resources of 126 million barrels of oil. This is a massive resource. The company drilled two wells back in 2019. At the time, the gas price was below $2 per MCF. As we're all aware, the gas prices have changed quite substantially over the last half year. And what we're now looking at is gas prices over $6 an MCF, which changes the economics of our Montney position quite significantly. Whilst we secured the Montney acreage and we proved up the reserves, we went one step further and we acquired the Tommy Lakes facilities up in the north of up to the north. Those facilities have the ability to produce over 50,000 cubic feet of gas per day, plus 2,500 barrels of oil per day. And they give us egress all the way through to Jedney, which is the main processing plant to the south. That processing plant has a replacement cost of about 85 million. We bought it essentially for $1. The reason it was so cheap was Enerplus were plug and abandoning a shallower producing field up at Tommy Lakes, and it was a perfect opportunity for us to pick it up. In order for us to unlock the value of the Montney, we would need to drill a pipeline that connects where our wells are currently at and our pad, and put some money into getting both the existing 2 wells on production and drilling additional wells. The wells up in the Montney are relatively expensive. It's something that we're looking at very closely. As our cash flows are increasing in our Alberta region, it does make the Montney something that's a lot easier for us to achieve. We have a very long lease out at the Montney. When we drilled those wells, we proved up a 10-year lease, which expires in 2029. So it's a significant option. Once we do make a commitment to drill up, to commercialize this acreage, it will convert what's called your development pending immediately into reserve category. So we've got about 45.6 million barrels of oil sitting there as, which will be recategorized as a 2P reserve. In addition to that, we have a significant number of competitors and peers to the south of us, and they continue to drill significantly in the region and have continually improved the economics on a well-by-well basis. So initially, these wells were doing around about 7 BCF of gas, and now they're currently doing about 9 BCF of gas per well. This slide shows us all the competitors in the region, and what we've seen over the last 18 months is a significant transformation of ownership. A company by the name of Tourmaline has gone about and acquired all of our competitors or peers. So they picked up Sowero in April last year for around 200 million for 50%. Polestar was a significant, well, it was a smaller competitor to our immediate east. And then they picked up Black Swan, which was a significant acquisition of about $1.1 billion. Tourmaline are now one of the largest producers in the Montney. In addition to that, you have CNRL that picked up Painted Pony for a $461 million acquisition, and Kelt and Conoco picked up Kelt's position for $550 million. I need to point out that all these acquisitions included production. So our position in the Montney does require, it can't be valued on a like-for-like basis on the basis that we don't currently produce in the Montney, but there is significant value in unlocking those Montney assets. And one of the main impetus to the changes in the valuation of the Montney is specifically the introduction of the first LNG terminal in Canada. So LNG Canada is currently being built at Kitimat. I'll just quickly go up the pages and show you where it's located. So here's LNG Canada. The pipeline that gets to LNG Canada from the Montney is around about 60% built. Everything's all approved and continuing under construction. And LNG Canada is also around about 60% built. This particular facility will take will commence production in early 2025, late 2024, and will take out around about 2 BCF of gas per day from the Montney, working its way up to 4 BCF of gas per day. It is a massive consumer of gas, and then produces LNG. Right now, the Montney produces around about 8 BCF of gas, and the vast majority of that gas finds its way down into the US. And that's what's driven the price of gas up in Canada, is that the US hasn't been investing substantially in its unconventional plays. They've been creating LNG terminals, and they need the gas, and they also need the gas internally. But with LNG Canada coming on stream in 2025, it's going to take a massive amount of gas out of the Montney, and that is ultimately going to put more pressure on the oil and gas prices in that region. Another important note is that we are operating in Canada. It's one of the most attractive ESG places in the world to work. It's a critical component to the way the Canadians operate. I've been incredibly impressed with the operations on site, as well as the fact that the company has what's called a very attractive LMR, which is an assessment by the state to determine whether you need to put any bonding in place. And we've got an LMR which says essentially that our assets are worth 5 times more than what they value the liabilities, which means we do not need to put any bonding in place. In addition to that, I think my time is up. So I'm going to revert back to Cyprus now, and we can to Sia, and we can start taking some questions.